When a Wall Street link analyst puts a multi-year price target on a major cryptocurrency like XRP, the market pays attention. Recently, a bold projection surfaced claiming that XRP could reach $12.50 by 2028, a target attributed to Standard Chartered analyst Geoffrey Kendrick and highlighted by crypto analyst Saif Crypto. This is not your typical social media hype or short-term price call. Instead, it represents a long-term institutional outlook rooted in expectations around ETF approvals, capital inflows, and evolving investor participation. But how realistic is this forecast? And what does it actually mean for XRP's future market position? So let's break it down step by step. So, why does a $12.50 XRP price target from Wall Street matter? A price target of $12.50 for XRP is significant, but just because of the number, not just because of the number, but because of where it's coming from. According to Saif Crypto here, the projection reflects the views of Geoffrey Kendrick, an analyst of Standard Chartered, one of the world's largest global banks. This matters because institutional analysts evaluate assets differently from retail traders. They focus less on short-term volatility and more on market structure, access, liquidity, and capital flow mechanisms. The fact that this forecast spans multiple years, extending to 2028, signals a belief in structural growth, not speculative momentum. Market-wise, such projections can influence long-term investor sentiment, particularly among institutions that value credible banking perspectives. Even if prices don't react immediately, these outlooks help shape narratives that drive capital allocation decisions over time. So, how do ETF approvals play a central role in this XRP projection? At the heart of Kendrick's projection is the expectation that his spot XRP exchange-traded funds, or ETFs, will gain regulatory approval. According to the post, up to 6 XRP ETF products could become active, dramatically expanding XRP's exposure to both institutional and retail investors. ETFs are powerful because they lower the barrier to entry. Investors who cannot or will not buy crypto directly can still gain exposure through traditional financial products. This improves accessibility, enhances legitimacy, and integrates XRP into mainstream investment portfolios. From a market impact perspective, ETF approval often signals that an asset has crossed an important regulatory and institutional threshold, potentially attracting a broader class of investors who previously stayed on the sidelines. So, can a $4 to $8 billion in ETF inflows really support higher XRP prices? Kendrick reportedly estimates that XRP-related ETFs could attract between $4 billion and $8 billion in inflows during their first year. On the surface, that sounds like an enormous amount of capital, and it is, but the mechanics matter. ETF inflows do not automatically translate into direct spot buying. Funds operate through authorized participants, creation and redemption processes, hedging strategies, and secondary market trading. This means a portion of the inflows may be internally offset, reducing immediate buying pressure on XRP itself. However, over the long term, sustained inflows can still contribute to price stability, liquidity growth, and market depth, all of which are essential for higher valuations. The key takeaway is that ETFs are slow-burning catalyst, not a short-term price switch. So, can XRP really change Ethereum's market capitalization? One of the most controversial aspects of this outlook is the suggestion that XRP could challenge or even surpass Ethereum's market capitalization during the 2026 bull market. This would represent a massive shift in the crypto hierarchy. From a market impact standpoint, overtaking Ethereum would require more than price appreciation. XRP would need persistent demand, increased settlement volume, and broader real-world liquidity usage. Market capitalization is not just about hype. It reflects ongoing economic activity and capital commitment. If XRP succeeds in expanding its role in cross-border payments, institutional settlement, and financial infrastructure, such a comparison becomes more plausible. Without that usage growth, however, the idea remains highly speculative. So, why are some analysts warning against overestimating ETF effects? Not everyone agrees with this optimistic interpretation. An ex-user known as Quantum XRP cautioned that ETF approvals should not be treated as a direct price formula. The comment highlighted how ETF capital flows are often complex and layered, involving intermediaries and offsetting mechanisms. Quantum XRP also challenged the Ethereum comparison, emphasizing that market dominance cannot be achieved without usage growth. According to his view, projections that lack a clear link between capital flows, network activity, and supply absorption risk becoming promotional narratives rather than data-driven forecasts. These warnings serve as an important reminder that institutional optimism must be supported by measurable on-chain and market activity to translate into sustainable price growth. So, why do some XRP supporters still believe the $12.50 target is achievable? On the other side of the debate, XRP Herald agreed with the projection, arguing that the $12.50 target reflects the combined impact of ETF adoption, liquidity conditions, and market timing. The comment suggested that if XRP begins to capture market share relative to Ethereum during the next cycle, the logic behind Kendrick's outlook may appear obvious in hindsight. This perspective highlights how long-term trends often become clear only after they unfold. Market cycles reward assets that align infrastructure readiness with institutional participation, and supporters believe XRP may be positioned for that convergence. And finally, my own personal opinion about this is that this projection should be seen as ambitious but not irrational. The $12.50 target is not a short-term call. It's a strategic outlook based on how traditional finance may increasingly interact with digital assets. That said, ETF approvals alone are not enough. For XRP to justify such evaluation, it must demonstrate real usage growth, liquidity expansion, and consistent institutional demand over multiple years. Without these fundamentals, even the most credible forecast remains speculative. Ultimately, this debate reflects a broader truth about crypto markets. Price follows structure, access, and adoption, not just optimism. XRP's future will depend on whether it can convert institutional interest into sustained economic relevance. And this finally ends our video. Thank you very much for watching and see ya on the next one.